Welcome, everyone, to the Exit Alternatives panel. We have an exciting panel today to discuss the most important topic to CEOs and their investors. How do you exit? Or more appropriately, how do you monetize your investment? I think most in the room have realized and seen the data. Fewer companies today are perhaps seeking IPOs than in previous decades. Private equity activity continues to increase, and global M&A activity has reached all-time highs. Will these trends continue, or will a new form of an exit alternative emerge over time? And more importantly, what is the best route for your company to take? Is it an IPO, a majority recap, or a full strategic sale? On the panel today, we have Matt Nerlinger from ServiceNow, Alan Cline from Vista Equity, and Jeff Thomas from Nasdaq. Please join me in welcoming our panelists for this discussion. To kick off, I'd like to have each of the panelists provide a brief introduction on themselves, and then we will dive into a couple of questions that I have, and then we'll open it up to the audience as well.
Hi, everyone. I'm Matt Nerlinger. I work on the corporate development and ventures team at ServiceNow. I've been at ServiceNow about a year. There's 5 of us on the corporate development and ventures team. Historically, ServiceNow, the company's around for about 15 years. We have been acquisitive, probably made in the order of 4 or 5 acquisitions a year for the last couple of years. We also have an active ventures practice, which again is the same team, and so we work together to do both those functions. Thank you for having me.
Hi, Alan Cline with Vista Equity Partners. I've been with Vista most of the last 18 years. Prior to that was a mixture of other finance jobs at Goldman Sachs and some entrepreneurial startups, including starting Fandango in 2000. Right now, I co-head the Endeavor Fund, which is our low market, higher growth fund inside of Vista. Vista is a firm, if you're not familiar with it, we started about 20 years ago, focused exclusively on software and software-powered business models, and have been the most active acquirer of software each of the last 6 years, and now manage just over $45 billion in capital across 7 different funds, 4 private equity, 2 debt, a small hedge fund, and a partridge and a pear tree.
I'm Jeff Thomas. I'm the head of listings and capital markets for Nasdaq on the West Coast. If any of you caught our CEO yesterday on stage, you know that Nasdaq's a global financial technology platform. We run 13 exchanges around the world. We power another 100 with our technology. But here in the US, we have a great franchise. We have over 3,000 listed companies that we work with closely. And I personally joined Nasdaq about 5 years ago to help set up Nasdaq Private Market, which is our platform where we help companies provide liquidity on that much longer path to IPO.
And perhaps that's a good segue. Thank you. Here at the Montgomery Summit, we feature over 140 private companies, many of whom aspire to be a public company one day. So Jeff, for you, when is an IPO the best path for a private company, and when is it not?
So there's really 4 reasons that a company would want to go public. First is access to capital. The second is to provide liquidity to their employees and shareholders. Third is really the visibility and recognition that comes with being a public company. And fourth is the ability to develop a more liquid acquisition currency. And so if we take each of those in order, one of the reasons we see companies staying private longer, there's been a big shift from public equity to private equity in terms of available capital. So many companies have access to much more capital through the private markets than ever before, which reduces the need to tap the public markets. In terms of liquidity, many companies are now providing pre-IPO liquidity, especially to their shareholders, in terms of their employee shareholders. But really, if the investors want to get liquidity, it often has to be either a trade sale or an IPO to have a big enough capital market. The visibility piece, I think, is most impactful when you're an enterprise company. So often when you're selling to other large enterprises, the transparency of being a public company, reporting your financials, they can see your balance sheet, can actually help drive new revenue. And then as a consumer company, sometimes that'll actually help build your brand as well. And then in terms of acquisition currency, it's harder to do acquisitions for stock as a private company, given that there's fewer marks in the market. Although we have seen that. In fact, I think I saw some news today that Airbnb acquired Hotel Tonight, so not impossible. But I think public companies, because there's a ready market for their shares, have a lot more access to providing that mechanism to acquire more businesses. In terms of when it's not, I think a lot of people spend a lot of time thinking about the actual transaction of going public, and we always use the wedding and the marriage analogy. Going public is relatively easy. Being public is hard. And so you're then faced with an endless series of quarters. You need the proper people, process, and technology to hit and beat your quarterly earnings every quarter. And there's just a much higher level of rigor that's associated with that. So you have to definitely make sure you've made the investments up front to be a successful public company.
Thank you. And Alan, as one of the more active technology private equity firms, I believe Vista has yet to take a company public through the IPO process. Why is that?
I think we generally like to look at it. We've never had to take a company public, but all kidding aside, I think you laid out actually the right reasons for a company to go public. And I would say, particularly if you look over the last 10 years, the bar for being a public company has frankly been raised for it to be a great idea. And I think our view is if you can get public, that is the wrong standard. You want to say, hey, being a sustainable public stock and public company for the reasons you outline, I think you want that to be, it's going to be a great experience for those things. Otherwise, I think you run the risk of, if you have a bad quarter, do you lose institutional support? Do you lose research support? And therefore, many of the benefits of being a public company go away. So from our perspective, I think we've invested or acquired a little over 300 companies over the years. And so far, we've been able to find cash buyers for those businesses for the most part, which has been a great liquidity route for our investors. Now, we have considered a half dozen of our portfolio companies for the public markets. And I believe, particularly in our larger fund, we will do more of that because the size and scale meets the criteria you laid out. But thus far, I think the cash has been kind of the right answer for if people have thought about where they want to go with their businesses.
Sounds like future business for you
Yeah.
over there, Jeff. So there you go. Since 2001, the majority of VC-backed exits have been via a sale. The top 10 tech companies today have $346 billion in cash on balance sheet, i.e. dry powder, and that is expected to reach over $1 trillion by 2020. So perhaps a question for you, Matt. What criteria are most important to you when evaluating an acquisition of a private company?
Sure. I'd say it sort of cuts across three different things: product, technology, and go-to-market. So on the product side, really we're trying to find entrepreneurs and teams that have a product vision and existing product that aligns with our product vision and roadmap. We want to be careful that we're not duplicating our existing product, and so the extent to which a company has achieved great success but has overlapping product, we don't want to frankly waste money on a business that is going to be duplicative for us. On the team side, ultimately our products and our sales are generated by people, and we want to find really good people and really good talent that can boost our own success. And so finding people with the right skill set, I think, is really important for us. And then lastly, on the go-to-market piece, there's a lot of areas. Our platform is pretty extensive. So we started in IT, which is still our core business. We've extended into a bunch of different areas. And frankly, you need different sales muscle to go after all those new areas. And so finding people that really have thought critically about accessing those buyers and what those buyers' needs are also important. Lastly, and frankly, I kind of left out of my top three was price. I would say, for the right acquisition, I think, deal structure allows us, we can be flexible with deal structure to make a deal work. And so we try to be very thoughtful in negotiations about, how we can make a deal that works for both parties. I would say it's exceedingly rare that we skip on a deal because of price. That being said, we've been very lucky and successful in growing our business organically. And so we don't feel, pressure to pay up in a lot of instances.
And most of the reasons you just mentioned are perhaps a bit more offensive alignment with strategic initiatives. When is defensive or the consideration of the competitive landscape a key factor in your decision making to move forward?
Yeah, I would say, very rare, if not never. I'd say we're always trying to think about how we can extend our product into new areas. We pay attention closely to what the competition is doing. but we have our own vision of what customers need and should do. And so, in general, I would say our M&A strategy is highly focused on being offensive.
Mhm. Great. And private equity firms have currently $1 trillion in dry powder, very similar to the cash and balance sheet of the top 10 tech companies. Of that $1 trillion in dry powder, 67% has been raised in the last 2 years. So Alan, question for you. Private equity firms are often perceived as favoring investments in more mature companies. What trends are you seeing in the shifting of profiles of private companies that are starting to receive private equity interest?
Yeah, Tej, I think it's a great question. I think it depends on the size of the business. I'd say the smaller you get, I think the premium on growth continues to be number one. I think as the companies get to a more mature state, call it 40, 50 million in ARR and above, you end up in a world where I think folks are looking for the business models to be working both on the full P&L as well as the unit economics. And as I think the trend we've seen recently, and these are trends that ebb and flow, so this could change tomorrow, is I think folks are looking forward on the economy and saying, hey, we're in a very long bull market run. You know, will the end of that occur inside of 2 years or outside of 2 years, which is super important if you're making a new investment today. And I think most folks would say, I'd take the under on 2 years on some sort of pullback. So what do you do when your job is to invest capital on behalf of your limited partners in that environment? And where we have moved, as well as I think broadly most private equity firms have moved, is a bit of a flight to quality, as best you can do in the private markets, which is a willingness to pay higher prices for companies that are growing quickly, are stone's throw break even if not profitable. Product satisfaction is extremely high, and the teams are executing extremely well. I think it's not a totally crazy hidden trend, but I would say that there's a huge shift of that. If you looked a year ago, 2 years ago, rising tide was lifting all boats. You could have an okay business and sell for a great price. I think back half of 2019, we're going to separate good from great in terms of both who is getting deals done and the values at which those great companies are getting bought. I think that's probably the biggest trend we're seeing kind of in the time period we're in right now.
One other trend that we're seeing as well is that companies are staying private for longer and raising more capital before an exit, and we touched upon that previously. However, at some point, investors, founders, and employees still seek liquidity. So question for you, Jeff. Explain the Nasdaq private market listing option, and when does that make sense versus a public market listing?
So the median time frame from Series A to going public has gone from 3 to 4 years in the 90s to over 10 years. I think great example, Amazon went public in 1997, 3 years after their Series A. Last year we took Dropbox public 10 years after their Series A. So you can see just the size and scale of these companies when they choose to access the public markets is different. But what kind of gets lost along the way is when companies are private for 10 plus years, the employees that work there generally have options that vest over 4 years. They typically do refreshes. But that's a big part of their compensation is equity compensation. And so what companies have been doing is starting to provide more liquidity to employees on that march to going public. So back in the 90s, the idea that anybody would get to sell their shares before the VCs was kind of sacrilege. Now you look at the stats from last year, we did 79 private liquidity programs representing $12 billion in notional value, and 76% of all the participating sellers in those programs were current employees. So why were companies doing that? It's to attract and retain talent versus their public counterparts. So if you work at a startup and can go down the street to work at Facebook where you get liquid stock options, that's pretty compelling. So companies now need to offer this as basically an employee benefit. The other thing they can do is use it to cycle out early investors. So if you have a lot of early seed investors with smaller funds, and then you want to bring in a great growth stage partner who's going to be there for the long term, you can actually use the private market to cycle those investors out before you're going public, and that can actually improve your aftermarket performance as a public company.
Great. And perhaps another alternative for these companies that do seek liquidity, whether it's the investors or founders or employees, is a majority recap. Alan, can you explain what is a majority recap and when does it make sense and how can it be helpful in certain situations?
Yeah, recently, I think folks will say, I mean, everyone, sees the larger take privates we're doing of MindBody, Marketo, Aptio, and whatnot, and they kind of think that's what Vista does. Probably 85% of what we do is not that. So the number one transaction type we've done over the last 5 to 6 years has been a majority recap. And what that is where an existing, a company says, hey, generally the profile is the management team says, hey, we're doing great. We love the journey we're on. We'd love to continue it kind of almost as is, but we have a few needs we need. We've got angels that have been in the business 10 to 12 years. We have some early VCs that are kind of wanting their money back. We have some more recent venture folks that may want a little bit of liquidity but would like to keep going. And the management team has regular needs of kids going to college, et cetera, and they would love a drink of water along the way, even though we're excited about where we're going. That is my idea, the perfect profile for majority recap, because we can come in and say, hey, you know what, we'll buy 51 to 75% of the business, and in that we can give, frankly, a great deal of flexibility to the different parties to say, where am I in my own personal decision-making process, and how can those needs be met with regards to liquidity for, frankly, even current employees, and then they get to kind of refresh energy and whatnot against the future with a fresh capital partner that's kind of geared up for the next 5 years. And that has been, I would say, by far our most popular transaction type. And I would say the theory of it is great. I think the practice of it is even better. I think the folks that have gone through that with Vista or others would say, wow, the 2 bites at the apple where I didn't have to sell the whole thing today, and then we got to take the run up again and participate in that was really fabulous. And the wealth creation on the second bump is usually 2 times or better what they would have gotten if they'd sold the whole thing in the first bump, even if they've sold some in the first part. So I think folks have been generally very, very happy with that.
And Alan, you mentioned the 2 bites at the apple. The ultimate second exit or ultimate exit could still be an IPO or a sale.
Or another majority recap.
Or another
I mean,
majority
we've got a
recap,
few of those where we owned a business actually here in LA, Accruent, where we owned it for 4 years. We did a majority recap with TA. We jointly owned it for another 3 years. We sold it to Genstar and another majority recap, and then they ran it up to where they sold it to Fortive. Our original check was $28 million. We sold it to Fortive for $2 billion over 9 years. That's a hell of a good run as a private company. And Bullhorn was very similar. We did a mostly a majority recap. Most of the investors kind of had sold in that, but management kind of rolled over significantly. And then they did exactly the same thing. We sold the business to Insight, and that business is performing extremely well, continued in the public market. One thing they thought about was, should we take it public? And that's one where you look at it, and I think the benchmark on what big enough to be a really great public company is, if they're a $140 million in revenue and probably on the edge of where you could go public, but in a cyclical industry, I think their view was, we're actually not that worried about the cycles given the way we've set up the business, so staying private continues to be the right answer, and the recap was great for them again.
Great. Maybe if we move on to looking at the options that we laid out for exits, an IPO, a majority recap, a full strategic sale, and looking at it, really dissecting it from the perspective of each of the stakeholders, the founders, the CEOs, the employees, the investors, and the customers. Jeff, starting with you, for the investors and shareholders, what considerations are most important to them as they evaluate the different alternatives?
I think as you look at an IPO, it's still very much the norm that existing investors and shareholders will be locked up for 6 months post-IPO. We still see a fairly low percentage of secondary offerings through an IPO. It's still mainly the companies raising primary capital and the existing investors staying locked up. And especially for venture investors, even once you've gone past the lockup, they're often going to be distributing shares to their LPs versus doing a follow-on or a managed secondary process, which is different than the private equity firm. So that can make it an even longer timeline to liquidity for their LPs. Versus in a trade sale or an all-cash sale, that's going to be immediately effective. And so I think that's one thing, especially on the investor side, that you have to consider is are we believers, as Alan has said, is this going to be a great big public company? Because by no means is the IPO the exit or the liquidity point. It's typically 2 to 3 years after that where the investors and the shareholders can get out. One interesting transaction last year, though, was Spotify's direct listing. They had some very interesting shareholders in the music labels who weren't naturally set up to be public equity holders. And so there was a lot of press around the direct listing, the fact that maybe they didn't want to have to pay the bankers their fees, but really the most crucial part of that transaction was all the shareholders in Spotify could sell day one. So there was no lockup period. The labels could get out of their positions in a very efficient way. Now, of course, with a direct listing, you're not raising capital. You're not out doing the traditional roadshow. So there's a risk that if you're not a well-known company, you won't get the coverage and the support that you need to be a public company. So I think it is going to be reserved for select companies, but it's at least a new page in the playbook that I think some companies are starting to look at.
Great. And Matt, for you, for CEOs who are very focused on what implications an exit could have for their employees and for their customers, what considerations are most important for them? And in the context of a trade sale, how important is that corporate culture, that alignment of corporate culture when you look at acquisition opportunities?
Yeah, we think and talk about it a lot with management team, and because obviously that's, this is their baby. Usually, a lot of times you have CEOs that are founders, and so they care a lot about the future of their employees. And so for every single deal we do, there's a deal champion. There's a corporate development team that supports kind of a product manager or head of engineering who's doing the deal, and that person is intimately involved working with that management team to understand like what their roles will be at the company, understanding the existing talent that they have and who they would report to, what their functions would be, where they'll sit. I mean, there's a lot that goes into that. And we also share a lot about our company culture early on as well to make people comfortable. But it's certainly part of the deal process, fairly early on for us to make that consideration. And there are definitely times where cultures don't fit, and it may make for not doing a deal. So it's definitely important.
Thank you. Maybe with the following two questions that I have, we'll just go down in order and get the perspectives from each one of the panelists. But for the first one, at what point in a company's life cycle in their journey should they start thinking about exit alternatives and start planning? And at what point do you prefer to engage with them around those exit alternatives? Maybe Matt, we'll start with you, and then we'll go down to Alan and Jeff.
Yeah. So I'll start by saying there's really no right or wrong time to start engaging. I would say that we are very interested in ServiceNow is a $40 billion market cap business, and yet we are constantly trying to attract new talent. And so we do, people call acquihires every year, which I think sometimes people get afraid of and don't like that term. But the reality is there can be really good liquidity options, and you can have a really great outcome by selling ServiceNow at an early stage. Or frankly, we will look at much later stage opportunities. So there's really no right or wrong time, and I would say, frankly, engaging early is usually helpful to build knowledge of your company early on, and to sort of socialize with people internally to see kind of how this could work together. Moreover, there's always opportunities to build partnerships, and I think having a good partnership that's successful, but from a commercial perspective, can be a very compelling reason to want to do M&A down the road. And so a lot of times M&A conversations actually start from a partnership standpoint.
So from our perspective, I'd say you do it when it's right for you. Again, no right answer. But if you can figure out like when you think you might be ready, I'd start 2 years in advance, right? It's come to an event like this, meet a bunch of people, get a sense for your different types of options. There's no one size fits all, and so the only way to figure out what's going to be right for you is to explore some of those options. And I always like to refer to try on a bunch of shoes and see which ones fit. And over time, then you will then gravitate towards a more narrowing of your options, and then particularly if it's a strategic acquirer, like our view when I was back at Goldman was, look, if it doesn't go to 2 board meetings to discuss it on the M&A committee, we're not buying it, right? And so you got to get well ahead of that. And then from a private equity or another kind of investor where you're going to work closely with them, you want to get to know them. I mean, I think the interpersonal fit is a super important part of that. And I think if you take the time to get to know one another over a longer period of time, a year plus, when you get to the point of a transaction, it's going to feel supernatural, as opposed to meeting people for the first time in a bake-off and saying, in 12 weeks, I've got a new owner, and how much time do we really get to spend with one another? That would be my advice.
So we talked about the process of going public is relatively short. You can go public in, call it 6 to 9 months from banker selection to pricing. But the process of getting ready to go public can take 2, even 3 years. And that's all about making investments in people, process, and technologies to ensure you've got the infrastructure to handle all the reporting requirements and the pressures of being a public company. One analogy I like to use comes from baseball, but Wade Boggs, when in high school and college, always used a wooden bat. And people would say, you could use an aluminum bat, you'd hit the ball farther. Why don't you do it? He goes, because someday I'm going to play in the big leagues. And so it's that attitude of running your company as if you're going to be marching towards the public markets and not underinvesting in those finance and legal functions, which frankly, it's, as a private company, easy to outsource, easy to kind of help your bottom line by not making those investments. Whereas once you go public, those investments will really bear a lot of fruit in terms of having that infrastructure to be a good public company.
Great. And perhaps with the final minutes we have left, let's all make a bold prediction. We're sitting here, 2030 Montgomery Summit, exact same panel, a few more gray hairs. What will we have seen in terms of exit alternatives? Is it trends toward more IPOs, majority recaps, trade sales, or is there a new paradigm that emerges? Matt, why don't we start with you?
I'm afraid to say in front of our Nasdaq friend, but yeah, I sort of feel like there's going to be a big opportunity for there to be private market trading, and I think the right platform perhaps hasn't evolved yet, or something that is out there but will turn into a trading platform for private markets.
Similar to that, I think the private markets have grown in their sophistication and diversity of what they allow in terms of operating as a private company longer and having more options for employee liquidity. I think if you looked, it's probably about 10 years ago, selling from a private equity firm to another private equity firm was considered a failure, right? You can't possibly, you all are the same, and if anyone's buying from you, it's because no one else was interested. And that has entirely gone away. That probably has been gone for 5 or 6 years. And I think it's part of that broader evolution of the sophistication of the private markets, and particularly, interest rates are going up, and in a low interest rate environment, when we look at our largest sources of capital, they basically are pushing more, gradually pushing more and more into the private markets because they are willing to take the liquidity trade-off for higher expected yield that still exists today. So I think those trends are, been really pushing into that world are going to continue.
So I'll make 2 bold predictions. First, last year we did $12 billion in private secondaries. We raised $21 billion on the public markets. I think the dollar amount of transaction volume on our private market platform will exceed the amount raised through IPOs on Nasdaq. So I do agree that that's the trend that's going to continue.
Bold prediction.
The other bold prediction is that I think if we're here in 2030, we will have been able to develop the second leg of our private market business, which is providing liquidity to LPs of private equity firms. And you'll actually see individual investors be able to put their 401k savings into private equity funds. We're working hard on that in DC with the SEC, with the IRS, to try to bring forward those changes, but we don't see anything that's going to reverse the shift from public equity to private equity. And so we're all in on building a stronger ecosystem, not only for the companies, but also providing broader access to investors. Sure. Because as a society, it can't be that a very small percentage have access to the best asset classes. We have to democratize it, or else we're going to continue to see the societal challenges that we have through income inequality, wealth inequality. So we think it's an important thing for the country.
Jeff, Alan, and Matt, thank you so much for sharing your perspectives. They were invaluable. Everyone, please join me in giving a round warm of applause for our panelists.